What are rational versus adaptive inflation expectations? Have you ever wondered how people predict inflation? Understanding how inflation expectations work is key to grasping monetary policy and inflation control. Let's break down two main types: rational and adaptive inflation expectations. Adaptive inflation expectations are based on what has happened in the past. People look at previous inflation rates to guess what will happen next. For instance, if inflation was high last year, they expect it to be high again this year. This method uses backward-looking information and adjusts expectations slowly as new data comes in. Essentially, current inflation expectations equal last year's expectations plus a fraction of the difference between what was expected and what actually happened. This slow adjustment can lead to delays in responding to changes in the economy. On the other hand, rational inflation expectations take a different approach. Here, people use all available information, including economic policies and models, to make their predictions. They do not just rely on past inflation but also consider how the economy is functioning and what current monetary policy might do. With rational expectations, forecast errors are random, meaning people do not consistently overestimate or underestimate inflation. This forward-looking behavior allows expectations to adjust quickly in response to changes in monetary policy. So, what does this mean for monetary policy? If expectations are adaptive, the central bank may need to raise interest rates significantly to bring down inflation. This can lead to temporary costs in terms of output and employment. However, if expectations are rational, the central bank can influence inflation expectations more directly and quickly. This means less disruption to the economy as people anticipate policy changes and adjust their expectations accordingly. Key differences between the two include the speed of adjustment and reliance on past data. Adaptive expectations lag behind actual inflation changes, while rational expectations adjust more swiftly. When expectations are rational, the economy tends to stay balanced, reducing the chance of inflationary or deflationary spirals. In summary, understanding rational and adaptive inflation expectations is vital for managing inflation effectively. It impacts how central banks design and communicate their policies to control inflation while minimizing economic disruption.